You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mark from The Moose on the Loose. Today, we are looking at the top 6 most generous, highest yielders of the TSX 60. So yesterday, I told you a little bit more about yield at retirement, the difference between low yield and high yield. There's no free lunch in finance. So today, I wanted to look at the 6 more generous stocks of the TSX 60 and try to figure out if they will be able to maintain or increase their dividend in 2025. Sometimes it is a risky play to go for high yield. We got, once again, a big example with Algonquin Power and Utilities, AQN, that cut their dividend a second time, where it was part of the highest yielders, and now it's back to like 5%. But after a second dividend cut, the stock price is going nowhere, so you have to be careful with those high yielder. So we're going to start with position number 6, which is definitely one of my favorite out of that top 6. Power Corporation, currently paying a yield of like 5.75. Pretty generous, but not too crazy. A good history of dividend increase for this one. So Power Corporation is pretty much a deluxe bond. If you look at the stock price, it's not moving much over the past 10, 15 years, but it pays a decent yield between 5 to 6% most of the time, offers a 5-6% dividend growth rate, which is quite generous for a high yielder like this. The business model is quite simple. A big chunk of their revenue is coming from the stake it has in Great-West Life. They also own Investors Group. They have other investments, so they're kind of like a small holding company. I mean, it's really big, but depending, you cannot really compare it to Berkshire Hathaway. But mostly in the insurance investment part. The part from Investors Group, IG Financial, not overly impressed by that part. I don't think it's gonna thrive. But for the Great-West Life and other investment activities, I think they're can pull out this dividend increase. So mid-single digit, that's what you can expect for 25. Definitely an interesting play if you're looking for more income than anything else, with a very solid balance sheet and a diversified business model, kind of like this one. Second on the list, TC Energy, ticker TRP, paying a yield around 6.4%, so a lot more generous. This one used to offer a 4 to 5% dividend increase per year. Now we're down to 3. The target is like 3-4%, but let's be honest, I'm pretty sure it's going to continue to be at 3%. This year comes with a little bit more not necessarily concerns, but unknown with the spin-off of a part of their business. So the idea here is to separate you keep the TC Energy with the natural gas pipeline, and then you have South Bow that will become the liquid pipeline. So we're really talking about one part about natural gas, the other part about oil transportation and storage. And the idea is to maintain the dividend after the spinoff. So hopefully we're going to have 2 companies offering a decent increase after that. But it's going to be a little bit more complicated to analyze this one going forward. My guess is the natural gas business should continue with a 3% dividend increase, but we'll have to see exactly how it turns out. So this one is on the bench at this point to know what's going to happen. There is more interest about TC Energy. I just covered that not too long ago on the Moose, where Enbridge and TC Energy is getting a lot of loves as of late. So it could be an interesting play, but comes with a little bit more uncertainties about what's going to happen between natural gas and the oil pipeline business. Moving on to number 3, Bank of Nova Scotia. Scotia Bank, BNS, 6.55. This one is about to report their latest earnings. I'm going to have a full video on my YouTube channel, so you can look at the Dividend Guy on YouTube. You're going to get this on Thursday, so make sure that you subscribe to the YouTube channel. Scotia Bank, known for its international presence. Now they have a new CEO. They want to clean that part because besides being a sexy story, it didn't generate more growth, didn't generate any like growth vectors besides just adding more volatility to the business, which was not exactly what you're looking for if you invest in a bank. Very sad news. This year, they called off the dividend increase. So no dividend increase this year. So if you hold BNS, you just suffered from a passive dividend cut of roughly 3%. Moving in 25, I don't think he's going to be any better. I wouldn't be surprised if there's no dividend increase from Scotiabank next year. Management said they're going to review, but I would not hold my breath. I don't think the dividend is at risk though, but if they increase it, it's going to be more like, we're going them back into an increase and we're offering like maybe a penny or something like that. I don't know, but I don't expect like a big increase. It's going to be like between 0 and 3% for sure in 25. Now, if you're looking for more interesting companies with lower yield and maybe higher dividend growth rate, you might want to start looking into the Rockstar list. That is a list of stocks that I'm maintaining up to date every month. You can download it at moosemarkets.com/rockstars, moosemarkets.com/rockstars, and the list is a complete list of stocks, Canadian and US, offering strong dividend triangle. So revenue, earnings, and dividend that are growing. It's a great place to start looking for potential addition to your portfolio. Now, moving on to number 4, we're getting close to the most important, most generous dividend payer of the TSX, Enbridge, another one that is getting a lot of love as of late, paying a yield of 6.9%. Used to be a very generous dividend grower, like to be like around 10% a year, but now we're back to 3. I do not expect more than that next year, but I do expect it's going to continue. They use a specific metric, which is called distributable earnings per share. So the distributable earnings is the money that it's kind of like a homemade non-GAAP calculation, but based on that, for their payout ratio is usually between 65 and 75. So leaving enough room to increase the dividend by another 3%. Not a super fan of this one unless you're looking for a stock price that is relatively stable over time and offers a good yield that is protected against inflation. So that's pretty much what you're going to get. Don't expect more than that, but it's still a pretty solid start. Now, kind of like interesting because the last 2 are 2 telcos, and I'm pretty sure you know where I'm going with that. When I pulled out those numbers, I was still surprised that Telus is the second largest dividend payer in terms of yield of the TSX 60. So Telus at 7.2%. Man, this one has been a frustrating stock to hold over the past couple of years. I was all super happy in 21 and 22 when the stock price rose almost close to $35. Now we're down to like less than 22, not ideal. Their differentiation, their dividend growers are not coming up right now as strong plays. So Telus Agriculture, Healthcare, International, they're not generating the expected growth, unfortunately. This year, they already raised their dividend once. They're expected to raise it again later down in 24. I think in 25, they're going to go back to something a lot more conservative, always looking at cash flow, but I expect like maybe 3% increase unless things turned out. But right now their cash payout ratio is close to 100%. So definitely a bit of a risky play. I'm holding on to my shares now, but I may eventually gotta sell them if the dividend triangle is not getting back on track. Finally, the last and the least, BCE, almost offering 8.5%. That is crazy. The problem with BCE, similar to what we see with Telus, they struggle to generate revenue growth, but their cash flow metrics are worse than Telus. For that reason, they went from the classic 5% dividend increases to down to 3% in 24. And between you and me, I don't expect more than 0% next year. I don't see how they would be responsibly managing their cash flow and increase their dividend. So I hope that they do not increase their dividend once again. Not for you though, but for the sake of the company, they should get their balance sheet straight. The interest charges is increasing very fast. It's not going to stop in 25. So I don't see why BCE should increase their dividend once again. So I'm not expecting a dividend growth there. So BCE, BNS are probably the two companies that are not likely going to increase their dividend. TC Energy and Bridge most likely going to be around 3%. I think that Telus will be in this range. And finally, Power Corporation, which is the last of the top six at 5.75, but this one is definitely a good balance between a decent yield and a decent dividend growth perspective. So I hope that you have enjoyed this episode. We're going to go back tomorrow morning, so make sure that you tune in and don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.